Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, December 20th, 2016. It's about 10:15 Eastern Time as I'm starting this video, so the markets are open for trading. Wanted to do an overview of a little bit of everything. I'll call this a bit of a potpourri. If time permitting, I'll get to some trade ideas at the end, but I wanted to touch on the broad markets, currencies, and maybe the metals and miners if time permitting, and go from there. Because a lot of those are intertwined, especially with what's been going on with the currency markets lately and metals. All right, so let's start out with the broad markets. And before I get into the charts, I do want to say this. And I share this every year. For those of you that have been following the site for a while, I always share my preference to really step back from the markets, maybe not 100%, but I am certainly trade a lot less heading into the last few weeks of the year. The reason for that is a couple reasons. I should state, and this isn't the reason I step back, but the seasonality tends to be bullish. I'm going to talk on that in a second. You tend to see a run up into the last few months of the year. They call that the Santa Claus rally. We may or may not get that, but most importantly is trading volumes taper off. As we head into the holiday season with everybody going on vacation. When trading volumes taper off, whether it's in December or around the 4th of July holiday, Thanksgiving, you name it, what that does is it increases the odds of false breakouts and whipsaw signals. It also increases the chances of stop rates. Stop rates are, let's say you have a stock and you're holding on to position, the long-term charts look good, you like the trade, maybe you just entered it and it went up against you and you're close to a stop. So let's just say the stock is trading above 100 and that's a well-defined, well-watched support level. Well, the trading desk at Bank of America, the guys with the big money, they see that. They see those stops. They can see where they're placed. You and I can't, but they know exactly where the stops are. And if volume is low enough, they're not going to move a stock like Apple, let's say, because that takes a lot of money. But a smaller company, if you're trading a smaller mid-cap stock, especially if volumes have dried up, they can take that stock down. All they have to do is go in, sell enough of it, run it down below 100, hit the majority of stops, they turn around, they buy those shares from you, and then they run the damn thing up. That's a stop rate. And that's one reason I'm more selective on taking new entries, why I might give my stops a little room as long as the chart pattern looks good. I'm not going to extend a stop or pull a stop just because the trade's going against me. But if it still looks good and I see those shenanigans, I see the low volume in the market, I see a lot of false breakouts, then I might give it a little more room, a little buffer on the stop. But for the most part, to try not to get yourself into that position, you shouldn't be, at least me. This is me just speaking. You guys do what you want. I don't go into the end of the year, 100% or 100% plus engaged into the market. I tend to keep things light and pass on all but the best looking breakouts. And if I'm trading, there's nothing wrong with day trading. Get in, see a breakout, hit it quick, get out. But again, it all depends on the chart pattern and the stock and what the markets are doing at the time. So let's take a look. And speaking of seasonality, before I get into the charts, I want to share one that member Joe Friday posted in the trading room. This is a great chart. Thanks for posting this, Joe Friday. Much appreciated. What he did here was put up a series of 3 charts just showing the end of December. So this is 2013, and we're looking at the market. It looks like he used the ES. Those are the S&P 500 E-mini futures. So this is the market, if you will. And you can see a pretty clear ramp into the end of the year. Back in 2013, there was an initial correction right away. Markets pushed back up, but they never even made it to that high that they had. I'm assuming the blue line is right at the end of the year, December 31st. If not, it's close enough. I can just make it out down here. Yeah, it looks to be the case. So I think this is the month of December. So there's your December ramp, your Santa Claus rally, and an immediate fade. Came back, never even got back to where it was. So if you shorted, just say on December 31st and held, you could have covered down here. That was a big correction. Fast forward, what happened in 2014? We actually had a big swoon down in November, if I recall right. Looks about what it was here. And an equally powerful ramp in December, right into the end of the year. And then look at that, another sharp sell-off. market didn't get back up. So the market went down for a couple months there, it looks like, for a while. So again, a pretty consistent pattern, at least in the last few years, of ramps up into the end of the year, followed by an immediate sell-off. We all remember, at least I remember clearly, I call it the New Year's gap. The first trading day of the year, if I recall, was January 4th this year in 2016, and we had a big gap down, and that gap was also below a well-defined trading range, and that led to one of the biggest corrections that we've had in years. So the pattern has been pretty consistent. Now, I'm going to say one thing. I don't want to try to give wishy-washy analysis. One thing I've noticed in trading is that very often, not always, but very often, by the time I realize that I recognize a pretty consistent pattern, whether it's in a stock or in the broad markets, it's almost about that time that it stops working. So just I'm throwing that out there, that you don't want to bet the farm on any one pattern. This may or may not be the case, but it has been recently. Now, what would add credence to this case, or this pattern playing out again, is the fact that the theme that I've been reading and hearing about lately is a lot of traders, including professional traders, institutions, are holding on to waiting till after the first of the year to sell stocks with the belief or the hopes that Trump's some of his tax plans, tax cuts will come into play, and we might see lower capital gains rate or lower income tax rates. If you hold a stock for 12 months or less, it's a short-term gain. A year or longer, that's a long-term capital gain. So if that's the case, then that would speak to the fact that traders are going to hold on to their embedded gains. The market's been in an uptrend, so you can only assume that the majority of traders right now are, with the long-term positions, especially investors, are profitable on average. Now, the thing about the markets, if everybody has that same mindset, that does seem to be the consensus from what I'm hearing, then those that are smart would say, well, if I hold into January, I need to have some stocks I need to sell. But if I wait till the first trading day of the year, we might see this again, as we did in recent years. And I'm going to get caught up in this. I'm going to try to have to unload my stocks in a very sharp sell-off. We could even gap down again, like the big gap down that we had in 2015. So I don't know. If I had to guess, I think that selling is going to kick in earlier. I think this pattern where you saw a clear rise right up into the end of the year, my guess is that we'll probably start seeing some profit taking kick in a week or so before. Now today's the 20th, so we don't only have another week or so in trading days left. 10, 11 calendar days left in the year. So anyways, food for thought. I just wanted to share that. But the point I also wanted to impress is be careful of taking breakouts, long or short, because the odds for whipsaw signals are increased. All right, let's run through the markets. Not a lot has changed. The near-term trend remains up and bullish. You can't knock that. You can't argue that. This is the index that I put probably the most stock into, for lack of a better word, our biggest emphasis on. This is a QQQ, the NASDAQ 100, and I've gone over this chart many times. Nothing has changed for a long time now. The trend overall, longer term trend remains bullish, but we've had a lot of corrections, some very profitable rips and dips. It's been a trader's market, as I've maintained for a while now. The broad market, the S&P 500, has gone virtually nowhere for years now. We're in yes, it's at new highs, but barely. We're talking just a few percentage points where it was trading over a couple years ago. So the trend is slightly higher, but pretty much going nowhere. However, there are these rips and dips, and the most important thing, at least that stands out to me, are these series of divergent highs. We have, over the last few years, and this is a 2-year chart we're looking at here. Very clear negative divergence. They're all marked here. So you have these divergent highs followed by corrections. I know there's been some talks that, technical analysis doesn't work anymore. Divergences don't work. They just get burned through. Well, keep in mind, we had divergence back here as well. Let me draw it out. It's not every single divergence isn't drawn on this chart. There was a smaller divergence right there, and it did play out for a correction. That divergent high did play out. So as I often say, nothing in technical analysis or trading is 100% effective all the time. However, much more often than not, divergences, whether they're bullish or bearish, play out. Play out for a trend reversal. Now, what we need to see, there's a little work that needs to be done here. I'm using the MACD right here. The MACD, oops, wrong tool. Clear all these out. The MACD is still pointing higher right now, or pointing up. It hasn't crossed over, so we need to see a bearish crossover. That blue line, the MACD line, needs to cross down below the signal line. At least this is in my book. I say, to me, this is potential divergence because that MACD is still moving higher, and it could continue higher, and then if it moves out above this previous reaction high, it takes out that divergence. And if it moves above this reaction high, then it takes out all the negative divergence. So right now, we still have potential divergence. However, both the MACD and the RSI are pointed higher right now. They're pointed up. So that means we need to see both of those turn down before that high is taken out, those previous reaction highs. I think it'll happen. And when it does, that can also happen with sideways price action. The MACD is a momentum indicator. So if you have sideways price action, the momentum slows down and you'd actually have a bearish crossover. But most importantly is this trend line. It's fairly well defined. This was a correction back there. There was a brief spike through it there, but we snapped right back up. Couple reactions here. So it's fairly well defined. And these two yellow lines make a big bearish rising wedge pattern with strong negative divergence. So I have not in the slightest way altered my view. I think a big correction's coming, and obviously at this point, even if it technically begins before the end of the year, you're not going to see the bulk of it manifest or play out, I should say, until 2017, but that could happen January, February. But from the look of this chart and from the look of this rising wedge, again, forget about all the other trend lines. Look at these yellow trend lines here. We're now at that point, close towards the apex of the wedge where it usually breaks down if it's going to break down. So something to watch for. Again, these are potential sell signals, potential divergences. We don't have any reason right now. I look at the 60-minute chart on the Qs. The Qs just broke out to new highs, took out this choppy, messy trading range. There's a minor trend line to watch there. But again, and that would be your first sell signal. But the big thing is to wait to see the rising wedge on the daily breakdown. So let's just take a look at the other ones real quick, not spend too much time with this. Here's the SPY. I have a lot of different boards. Boards are different levels that I've drawn, trend lines. This is similar to the one I just had here. So let's just look at this one. Looks like a big rising wedge. We had a breakdown. It looked like the real deal. Looked like things were going to get going. And then what happened? Well, we had a shocking surprise presidential election here in the U.S., and that's the Trump pump. A lot of repositioning happened, caught a lot of traders off guard. People couldn't get enough bank stocks and everything in hopes of the repeal of Dodd-Frank. Biotechs rallied, but a lot of that rally's been faded since. But from a technical perspective, forget about what happened. Let's just look at what happened in the charts. These are your trend indicators. When the MACD is above zero, I use the 9 EMA, the trend is bullish. And when it's below, the trend is bearish. So right now, the trend is bullish. However, a couple things to note. We have what I call a high-level crossover. If I put a horizontal line here, and I touch, back where we are, or you can take this horizontal line, go to the left. That's about the high end of the range that the MACD gets to before it turns down, and we see corrections. It's currently pointing lower, about to make a bearish crossover if it hasn't done so already. I'd have to put a histogram up here to see, but you can see the lines pinching. We're extremely overbought. You have divergence here on the MACD. You don't have it anymore on the RSI. Because the RSI just punched up to make a new high. However, the RSI is at rarely seen overbought levels. It almost hit the 80 level on the daily chart. Looks about close there. So you have an extremely overbought reading. You have negative divergences. You have a rising wedge, which broke down, back tested, then we pop back within the wedge. But at this point now we have these intersecting trend lines. You have the rising wedge, this line and this line here. And I put in this minor uptrend line as well that comes off the lows. So really you have this area right here of intersecting trend line support. That's a level to watch on the SPY, because if that pops, that would trigger a move down, and I don't see any decent support all the way back down here to about 220, and that would be a test of the recent highs. 220 goes, then you're probably coming all the way back down here, and we'll just have to go from there. We'll watch these trend indicators, see what they do. You know, if there is a correction, does the MACD hold and stay in bullish territory, or does it come down into bearish territory and signal a new bearish trend? Et cetera, et cetera. So that's the broad markets. I don't want to get into too much here. We'll look at IWM. IWM is what I'm watching. IWM has it became extremely overbought. I don't know if it's been this overbought throughout this entire bull market on the daily time frame. You know, it hit a level, looks like it hit 80 or more on the RSI, and then we had a double tap, 2 close consecutive overbought readings, very extreme overbought readings. Both of that created a divergent high, negative divergence. That divergence shows better on the 60-minute. Let's take a look at that 60-minute chart. This is that divergent high I'm talking about. Doesn't show it on the RSI, but it was negative divergence on the daily time frame. So you had this rising wedge I pointed out. You had a divergent high here. That was marked right here. I don't have it all drawn out. No reason to have too many lines. There was a divergent high there, and it did lead to a correction. Certainly did, as most divergent highs do. Wasn't a very big one. Prices pushed higher, put in a second divergent high, broke that minor trend line, then we broke this other uptrend line. But prices have sort of been grinding around. And again, this is year end. The markets, you know, the small caps, even though they're not going any higher, they peaked out over a week ago. They're trading sideways. The large caps continue to move higher, but these guys are they just got ahead of themselves. So at best, this looks like a dead money trade, maybe into the end of the year. Now, I'm not speaking literally. I'm speaking maybe a little bit upside. Who knows? Maybe a back test of the wedge and then a move down, or maybe nothing at all. If it breaks this recent trading range, we're going to go down and hit any or all of my targets. So I do expect these targets to be hit in IWM. But again, end of the year. The market may want to hold up if everybody's holding on to to wait to sell until January, then we might see another week or so of sideways choppy action. But there it is. The bearish technicals, the case for a reversal, especially in IWM, is in place. But for the most part, again, don't trade the broad markets. There's just so many better trading opportunities on individual stocks right now. Because as I always say, when you short the broad markets, you're shorting the good with the bad. You're shorting dividend-paying stocks with growth stocks. You're shorting undervalued stocks with overvalued stocks. But I know a lot of people like to trade the broad markets, so that's why I do the coverage. And it also helps us kind of gauge, where we should align our trades if we're trading individual stocks or sectors. So, all right, that's it for the broad markets. Let's see how much time is left. All right, we got a little bit of time. Let's just talk currencies. And if I have time permitting, I'll get into gold. All right, so currencies. The big one, the US dollar. This is the dollar index. Let's not even bother with that daily chart. Let's look at a weekly chart. This is almost 10 years. Yeah, this is 10 years. 10-year weekly chart, and this chart speaks pretty clearly to me. What I'm looking at here are these divergent highs on the weekly time frame. Back here, we made a divergent high. You can see that. I'm sorry, we made an overbought high. We had a second overbought reading right about this 70 level, that red line. But these were 2 consecutive readings. Now, that first overbought reading certainly did lead to a sharp correction. The dollar index pushed a little higher, made a divergent high, and then came the big correction. Very sharp move, almost retraced the entire move up. Fast forward a couple years later, we had pretty much a single reading above the, there were 2 peaks, but about a single reading above the 70 level on the RSI. And we had a huge correction, and that fact wiped out all and then some of the previous advance. Back here, we didn't quite become overbought, at least not by the traditional measure of using the 70 level, but we did have negative divergence both on the PPO and the RSI. So you had this divergent top correction. Come all the way back into late 2014, we had an extended. I don't think we've seen anything like this, at least not in recent history, with the dollar index being so overbought. We had a tremendous run up, extreme and persistent overbought readings. You look how these overbought readings, that's one single cluster. We remained above that 70 level, and it certainly did lead to a correction. It was a sizable correction in the dollar, but what happened from there? The RSI moved back down and has now moved up once again to overbought readings. So what we have here is a very long, powerful divergent high. So we have the dollar index is overbought right now and has a very powerful, much more powerful than this divergent top, very powerful divergent high. Now, the reason I'm expecting a trend reversal, you can't, there's absolutely zero signs of it yet. What I noted here is that you can see the PPO is still pointing higher. That's what the white arrows indicate, as is the RSI. So in other words, this is only potential divergence. To confirm that divergence, we need to see a bearish crossover in the PPO, so the PPO needs to turn back down, and the RSI needs to roll over. And it needs to do so before we take out those previous highs, those reaction highs. Right now, that shouldn't be a problem at all because we're still well below there. So this is setting the stage for a major reversal in the US dollar sometime in 2017. All right, so that's there. And again, we need to see this evidence. Anything is possible. These divergences can be burned through, but that's what I'm looking at. So we'll just have to monitor this one day at a time. Now, to drill down a little deeper, if you want to know where the dollar is going, you only have to know really where one, at most two currencies are going, and that's the euro. And we're going to look at the euro against the dollar and the Japanese yen, because the euro is by far the largest component. Over half of the dollar index is made up of the euro, with the yen being the second largest. So those two alone make up the bulk, almost the vast majority of the returns of the US dollar index. So here's the euro. This is a weekly chart, nearly 10 years old. Going back to roughly 10 years old. And you can see the trend. It was in a large sideways, almost a triangle trading range. It broke down. And since really, what was that, early 2015, so for the last 2 years, the euro/US dollar pair, so this is the euro against the dollar, has traded in a sideways trading range. And there have been trends within there. You can see these uptrend lines. What happened recently? This is pretty significant. We had a breakdown of that trading range. Now this reminds me of something, and I'm going to get to that in a second here in GDX. This, I believe, will be a false breakdown. When you have a breakdown of a well-watched trading range, such as you have here, it does a couple of things. You have capitulation from the last of the weak-handed longs, those who were long the euro. They capitulate because they see, well, this is a technical breakdown. We just broke down. We've been basing or consolidating, trading in a 2-year range for the last 2 years. We broke down. You also have shorts pile in because that's a technical breakdown. However, we have very powerful negative divergences. They're only potential because that PPO needs to curl up. The RSI needs to turn back up, but you can see I've drawn the lines. I expect that to happen. You can't bet on it until it does. You can if you want to speculate or maybe take a shot here. And again, I'm not a big currency trader, but where this goes into, it really plays into where gold is probably going to head. This reminds me exactly of what happened in GDX, if it does play out this way. In GDX, I talked about, if you guys recall, for those of you who've been with the site, heading into the end of 2015. Let me find a clean board here. I've got to have one somewhere. Oh no, I'm looking at a weekly chart. Let me go to a daily chart. It'll be a little easier. Okay. All right. At the end of 2015, I laid out a scenario that I could see happening, and it's exactly what happened. Was we had a trading range here, and that was the $13 level. If I put a horizontal line, let me do that for you real quick. Put a horizontal line at 13. 13 was bang up support for the GDX, the Gold Miners ETF. And we had a trading range since the summer of 2015, and GDX continued to find support. And I also pointed out that gold had bottomed back in December, yet what had happened, and a couple weeks before it happened, I laid out a scenario of a flush out move, a washout move, a breakdown below that support, which is extremely bullish because what that does, it capitulates. We were coming off the tail end. This was the end of a vicious bull market in the gold mining stocks, one of the worst in history. And So what that does, after a basing pattern like that, you have those that had held and ridden out the whole thing or tried to catch bottoms along the way, and they're underwater. That tends to wash out the last of the weak-handed longs. It also tends to suck in a new subset of short traders. They see a technical breakdown, and that adds fuel for this rally. So that's what happened. That's what I call a fake down or a false breakdown. And that's what I think is going to happen here in the euro more than likely. It's hard to say when, but I can tell you when after the fact, it won't be too late, is when it snaps back above. This was, my expectation was we broke down, went down a couple weeks, a few days, snap back up. So look for that in the euro. GDX, this was the bullish event. Once that false breakdown happened and we regained that level, got back up in there, shot back up, and especially broke above the top of that basing pattern, that led to one of the strongest rallies in GDX in many years. And again, go back to the euro, euro USD, where'd it go? Somewhere here, there it is. Weekly chart, there you go. So let's see if we see something similar, and that's what you want to be on the lookout for. So if you're, pretty aggressive and you trade currencies, you could take a shot here. It's hard to say because the reversal hasn't happened yet. You can look for, go down to the daily chart or 60-minute to really time your entries. You can see the bullish divergence forming on the daily chart. I drew it out right here. Positive divergence, unconfirmed yet. So look for maybe a bullish candlestick reversal pattern going on there. Look for confirmation, the MACD turning up, and then the euro regaining that level. It's about 105, so somewhere around there, 105.3. Okay, I'm going to wrap it up here with the yen. We'll have to get into gold and some of the trade ideas in another video. Here's the US dollar, Japanese yen pair. So it shows the dollar against the yen. The other one was the euro against the dollar. So you flip it around here. When that chart is bearish, the euro dollar chart, euro US dollar chart as it is, that's the euro dropping against the yen. In this case, this is US dollar gaining, against the euro, the other chart. Getting all confused here. This is a US dollar versus the Japanese yen, so it shows a strength in the dollar against the yen. This was pointed out before it even broke out on the site. This bullish falling wedge, it was confirmed with divergences. It was textbook. We had a breakout, started to run, pulled back, and then from this point it just exploded. And the move has been one of the strongest moves in many years. So we've come full circle. We went from having a bullish falling wedge with a divergent high to now this trend line is questionable. I'll highlight it. It's very steep. It may be the trend line that comes into play here. There are a few reactions. So we have a very steep rising wedge. I know these divergences aren't very large in scope compared to these divergences, but they are there. They're negative divergences. They're confirmed. You can see everything turning down now. We have two higher, lower peaks in the RSI and MACD. There's a rising wedge. So again, this trend line is very steep. That may or may not be the catalyst when we get a break of that trend line. But any of these levels here that you see, the horizontal lines are targets. So this aligns with what I'm looking at. So if you watch that euro chart, you see that false breakdown that I just mentioned on the euro, and you see a breakdown here on the dollar versus the yen. That would mean the yen's rallying against the dollar or the dollar's falling against the yen, and then that would all play into that whole US dollar index thing, because as I said, you just watch these two pairs. Where these go, that's where the dollar index is going. And then that plays into gold. Gold and GDX warrant, and silver, they warrant their own coverage, so I'll do that either in static posts or in a video update, as well as some of the trade ideas that stand out. Just because it's the end of the year doesn't mean we can't make money. There's always some things popping here or there. And more importantly, we need to start. This is a good time to kind of strategize, get your bigger picture formulated, where you think things are headed in 2017, and be ready. And that's what I'll do for the remainder of the year. I'll clean up the old trade ideas that have already hit price targets or stopped out. I'll get those off the site, move those into the completed trade category, and then try to hit the road running at the first of the year with a lot of new trade ideas, new setups ready to be triggered. That's what I'll be working on for the next week or so. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.